On the Express this week, the Sell America trade heats up. Bang your head because the heavy metal trade goes to 11. Get your notebooks ready for an economic policy portfolio primer as Terry Haines of Pangaea Policy drops in for a few good minutes. Are our investors swimming naked from the beach? The biggest week in weeks is here as the Fed meets and the biggest companies try to impress with their earnings beats. To the beat, turn up the heat. There's 2 feet of snow up and down my street. Can't skate through the sleet. Gonna shred instead. It's the Investopedia Express, all up in your head. Welcome back and welcome aboard. Coming to you live and direct from the Harlem headquarters, the home office, the original home of the Investopedia Express, launched here about 5 years ago. Too cold out there. Winter Storm Fern doing a number on the United States. Such a nice, kind name, Fern, for such a intense storm. But we are here live and direct, as always, every Monday at 10 a.m. Welcome to our live viewers from around the world. We know the Investopediacs are out there tuning in, trying to get smart for the week ahead, and we got a busy week coming our way. U.S. equity markets pretty flat. Hello, Kalovic, and good to see you on Instagram. Thanks for dropping in. Henry Delon is here. Well, as always, welcome. Thanks for joining the show. We appreciate all you guys dropping in. Hey, 01ZO, thanks for joining us on the Investopedia Express. Always good to have the Investopediacs live and direct. You know we are live every Monday at 10 a.m. and then on demand on your favorite podcast networks. We've got a busy show and a huge week ahead of us today, so let's get to business. U.S. equity markets kind of flat to start off the week. Last week, the second kind of losing week of the year, as the Sell America trade was heating up, and there are risks everywhere you look this week. We got a huge week of earnings. We got the Mag 7 companies reporting. We got more than that. We got the FOMC interest rate decision on Wednesday. We'll break that down. And then the Sell America trade back in focus following Davos, with the U.S. basically sticking its finger in the eye of Europe over Greenland, demanding that, of course, Denmark sell Greenland. We came to an agreement, the United States and the Trump administration did, with the European Union and Denmark, apparently, that'll give us, the United States, access to those rare earth minerals and the ability to put up that Golden Dome defense force. So there may be no sale in the works of Greenland, but we, the United States, will be using it pretty heavily. But a lot of risks out there, and another deadly shooting of a U.S. citizen by ICE agents in Minneapolis over the weekend. That's drawing some political and corporate backlash. And that Sell America trade we talked a little bit about last week, that seems to be heating up again. And it's bringing the word trust back into the vernacular. The big question, do investors trust the United States right now? And trust is really at the heart of the capital markets. We know that. But you can see that trust eroding a little bit in the sell-off in U.S. Treasuries. Look at the yield popping there a little bit last week. U.S. 10-year Treasury yields north of about 4.2%. The higher that goes, the more turbulence you see in the U.S. stock market, because that is the clear sign that investors don't want to hold our debt. That said, U.S. Treasuries are the biggest and most widely held asset on planet Earth. So not so easy just to get them off your books, but you saw that yield popping higher. That's a good example of that. You also saw the U.S. dollar falling, declining, and now it is at a 4-month low. Now, sometimes U.S. businesses like a weaker dollar, and we know we've had a weaker dollar really for the past year since this administration came into office, but that's at a 4-month low right now. So the sell-off in treasuries, the sell-off in the U.S. dollar against other currencies, something to watch. And then emerging markets at all-time highs. We saw this trend in 2025. It's back, baby. Emerging market stocks at all-time highs. I've been looking at the iShares MSCI Emerging Markets ETF. Check that out. And what are we talking about when we're talking about emerging markets? We're talking about South Korea. We're talking about some of the smaller European countries. We're talking about Vietnam. We're talking about Thailand and other countries benefiting from this Sell America trade that has sort of been gripping the markets really for the past several weeks, but really intensified last week in Davos. I mean, I've been to Davos, and Davos is usually not that much of a news-making type of an annual gathering, but last week, totally different situation with the United States taking center stage there, basically demanding the sale of Greenland or the access to those minerals and to the ability to build up our defense systems in Greenland, but also taking shots at European countries pretty much all over the place yesterday. So you see that happening, and then you see this heavy metal trade just ramping up. You like heavy metal? Well, turn it up, my friends, because heavy metal is going to 11. Gold at record highs, melting up through $5,000 an ounce. If my grandfather knew that gold would be worth $5,000 an ounce, he might have changed our name from silver to gold, but he might have kept more of that gold. $5,000 an ounce. Who would have ever thought that? Shooting through $5,000 an ounce as you, as investors around the world, are grabbing onto that safe haven because it's really the only hedge right now against the stock market. Yeah, there's crypto. Yeah, there's other asset classes, but if treasuries are selling off and the dollar's selling off, you see investors grabbing gold as much as possible. But not just gold, silver also at record highs, $110 per ounce, and that is the little cousin to gold, but it's also pretty useful in industrial production, especially in defense, especially in technology. In what we're building these days with semiconductors, you're going to need a lot of silver and you're going to need a lot of platinum, which is also at a record high. So the precious metals, the heavy metals, they are up at record highs. Safe haven asset on the one hand, on the other hand, pretty useful for defense production, manufacturing, industrial production in general, more government spending. You're going to see these asset classes continue to rise. Gold, silver, and platinum all at record highs and probably heading higher. And that's what we're seeing these days. And that's about government spending. That's about spending on defense, as I said. It's about technological innovation, and it's about economic imperialism. And one way or the other, that's kind of what we're facing lately with the United States exerting its force around the world. So speaking of that imperialism, the Trump administration's invasion of Venezuela and its demands that Denmark sell Greenland to the US, they may seem like isolated pieces and acts of aggression and provocation, but they are anything but that, my friends. It's a calculated strategy to reset America's economic, military, and technological dominance over the rest of the world. It's empire building at its finest, and it's following a strategic blueprint that will have human, political, and investing ramifications for generations. As investors, we have to know the policy driving the provocation because, like it or not, it has portfolio implications for us. And when I want to know the real deal in political policy, I read and I watch everything that Terry Haines of Pangaea Policy says and writes. He's got his fingers all over the pulse of policymakers and what their decisions mean for our portfolios. And he joins us now on the drop-in. Terry, thanks so much for joining us.
It's an honor to be here, Caleb. Thank you for having me.
I'm a big fan. I watch you on Bloomberg Surveillance every time you're on, and I read your notes. But help us put into context the Trump administration's invasion of Venezuela, the demands on the European Union and Denmark to sell Greenland in terms of the overall foreign and economic policy this White House is pursuing. And as you pointed out in a recent post, this is all part of the plan laid out very clearly in the White House's national security strategy that was released back in November. But for our listeners and viewers, help us create the through line there.
Yeah, absolutely. Thanks. I do think there's a through line, and I think it's pretty clear. The national security strategy that was released in November, among other things, I think is one of the most transparent documents any United States government has ever put out. I mean, it's very explicit. I mean, it's general, of course, but it's very explicit about what aims and goals are and what and how they perceive the interests of the United States, both geopolitically and by extension economically. So I think that's very important. The Trump administration's interest in this, frankly, goes back into the Biden administration, and not in the way that you might think I'd set this up. In 2024, there was a blue ribbon panel of defense experts that came out with a view about the defense industrial base and concluded that the defense industrial base of the United States was not able to support, sustain, fight any sort of long war, and recommended a bunch of steps to rectify that absolutely as quickly as possible. I used to say in the 2024 campaign, the one thing I knew was that regardless of whether Trump or Harris was going to win, that those recommendations would be acted upon, and that economic policy would look different than it had in the Biden days. Sure enough, in the Trump days, I think that's become very true. Besant talks about, I mean, just kind of the tops of the waves here. Besant talks a lot about, and has for almost a year now, about national security being economic security and economic security being national security. That's a very clear signal that what they will do what they need to do with domestic U.S. economic policy in order to advance the geopolitical interests of the United States. The entire big, beautiful bill of spring summer of 2025 is designed to do just that. They are doing absolutely as much as they can, among other things, to onshore manufacturing, particularly for critical defense industrial related areas. And the reason they're doing that is because they want to avoid any sort of situation in the future where the United States cannot get critical materials for whatever reason, whether it be defense or defense related.
Yeah.
Uh,
Going through just the tenets though of that
yeah,
document, that report,
yeah,
balanced trade, so
right,
tariffs, obviously, that's been
right,
the weapon for that. Securing
right,
access to critical supply chains and materials, right? See Venezuela, see
exactly.
Greenland, reindustrialization, reviving our industrial base, as you just mentioned,
Yeah.
energy dominance, and preserving America's growing financial sector dominance. That is a broad agenda that has broad repercussions across the global economic landscape.
Oh, hugely, but it gives you an idea of it gives you an idea of why today the United States government has its hair on fire about a bunch of these things because they believe, rightly or wrongly, I think the market signal here is that they're going to act on this stuff and are acting on this stuff. That the United States is deficient in all of those areas and needs to work as quickly and as hard as possible in order to catch up in this global competition with China.
Yeah, and you could see it, and you could see it extending its economic imperialism or influence into areas of the globe where we really hadn't paid too much attention over the past few years. But this agenda actually goes back to the first Trump administration in terms of Greenland, in terms of
Mhm.
expanding economic power and influence. So it's manifesting in various ways, invading Venezuela for one, the demands to sell Greenland for two. Where else is it going? Where could this end up if you look out the next 2 to 3 years?
Well, I think it informs the United States policy in the Middle East and the priorities there in the Middle East, not just with Israel and frankly maybe not even principally with Israel. One aspect of the Trump administration's trade policy is what I call interdependence, the idea that weaving closer and stronger economic ties, not just with allies, but with major non-aligned nations, is also a way to bring and keep those nations much more on side than they might otherwise be. And yeah, I think that is a much more explicit echo of the kind of things that happened during the Cold War. But there it is, and those countries in the Middle East, particularly Saudi Arabia, the Emirates, Qatar, are all deemed to be very, very important to United States interests. You see the pushback on this even in what China wants to believe is its home sphere of influence. The actions we take to shore up Japan, Australia, the pushback we have in the South China Sea, our support for the Philippines, a variety of things like that, South Korea. So there's that. Thirdly, you see this up and down the Western Hemisphere in actions in places like Panama, where Trump a year ago was derided for being interested in Panama, but when you've got a world where Chinese control ports on either end of the isthmus, then it's a very different look, and there's a much more general understanding now that that's all part of shoring up the Western Hemisphere defense and Western Hemisphere sphere of influence.
Yeah, if you've been down to South America in the last few years, you know China has a heavy influence there as well. And in Africa, the U.S. was not paying a lot of attention to big investments in those continents, but it looks like a lot of that
Right, right.
that is
China
changing.
is the biggest. Yeah, China is the biggest trading partner in South America, and Venezuela is a lot of things, but one of the things it is to the Chinese is a gas pump. And so the Maduro action was designed to stop that.
Yep. All right. But when you look at all of this and you look at the fact from an investor point of view that in 2025, the best performing stock markets in the world were not here in the United States, far from it. We had countries like South Korea outperforming. We had Poland and Greece outperforming, in some cases, 2xing what was happening here in the S&P 500, if not more. Why do you think that happened, and what do you expect to happen in 2026? More of the same?
Well, the returns in terms of percentage are larger. The returns in terms of the dollars, of course, aren't.
Yeah, not a lot of money in those
Yeah,
markets.
yeah, but I expect more diversification. Outside the United States, I hesitate to say away from the United States. The United States remains the most investable country in the world, and it's a tribute to those other places, frankly, that they're seen as more investable. And investors continue to look for alternatives outside kind of the core United States. Uh, Interests, and I think they also look for investing opportunities that are outside of China because China, if anything, has gotten less investable.
Yeah, and they found them underground too. Gold, silver making record highs throughout 2025. That's
Exactly.
continuing already into the first month of 2026. That safety hedge that a lot of investors who want to believe that American companies are going to continue to grow profits as they have been over the past few years with hedging that maybe this economic plan might not work and might be a good time to hold on to precious metals. Do you expect that to continue?
Yeah, I do because you've got for at least the last 4 years, you've got the highest geopolitical risk in over 50 years, and I think the last time it had spiked as high as it is now is probably 19 fall of 1973 between the Yom Kippur War and the resulting oil shocks that came from that. The last time that the United States upped its DEFCON nuclear was then, and compared to today, though, today's a worse situation in a lot of ways between Ukraine, the Middle East, the South China Sea, Chinese adventurism in all kinds of places, and so there's greater uncertainty, and that always manifests in precious metals.
Yep, that they've been on quite a run, and the uncertainty is probably going to continue. There's unpredictability in terms of what the administration says, but the plan has been carefully laid out in a bunch of documents going into already in their second year of office. All right, let's focus here domestically on the U.S. economy. You know this, the headline numbers are strong. GDP is strong. We just had that third quarter revision, 4.4%.
Right.
Wage growth remains strong. Inflation's kind of cooling a little bit. The labor market not so hot. And people, though, still feel terrible about the economy. It's a midterm election year. Those are notoriously volatile. How's all that stacking up in terms of your handicapping of what might happen in those races?
Well, I think it's important to understand that we have a very closely divided Congress right now. That happens to skew in the Republicans' direction. But my mantra always is that majorities do not equal control, and you'll find an awful lot of loose-lipped media talking about one or another party controlling the House or the Senate. And then in the next breath saying that the leaders don't feel like and aren't demonstrating the ability to control. So there's not a lot of control that goes on. Right now, the Senate, just by virtue of the races that are up, and there's roughly a third of the races a third of the seats up every 2 years, probably tips to remain Republican after the 2026 midterms. The House is much less predictable today. You've got, depending on the day, anywhere from a 1 to 5 seat majority in the House for the Republicans. And what you've got in the House today is 435 seats, and about a tenth of those are open seats right now. So they're up for grabs. I think it is not at all. I have 60-40. The Republicans will maintain a small majority. The reason why I say that very simply is, firstly, we're way too far out to handicap. Anybody that's telling you, as I heard somebody say the other day, well, we think it's on track to, the Democrats will pick up 25 seats, is smoking
Yeah,
something.
it's January,
It's,
people.
it's yeah, it's way too early in a world where you don't even know who a lot of the people running will be. You can't handicap a race, no matter what anybody's telling you. Beyond that, uh, Democrats have an electability problem, and let me describe it briefly two ways. One is that you hear a lot of talk about the president's popularity being underwater. That's very true, but everything's compared to something else. And Trump, by far, is the most popular entity politically in the country.
In the
Uh,
world.
well, I mean, his favorability is down is -7 to 10. But one way of looking at that is in the second Bush 43 term, the second Obama term, they were roughly in the same place. The other way to look at it is that regardless of how popular or unpopular the president is, Republicans generally are much less popular than the president, and Democrats are very much less popular than Republicans or Trump. So there's a hole to dig out of. And the second point I'll make briefly is that I think Democrats have what I shorthand as the Jasmine Crockett problem, which is really an electability problem. If they want to have candidates for the House seats and the Senate seats that are centrist in kind of the mold of now Governor Spanberger in Virginia, Governor Sherrill in New Jersey, they will do better, and they might well have a small majority in the House at the end of the day. But if they're going to nominate the Jasmine Crockett's of the world, the extremists, what you're going to get is a world where Republicans will be running as effectively as the pragmatic centrists, and Democrats will be running as neither pragmatic nor centrist, and that will negatively affect the race. So it's way too soon to tell how that's going to shake out.
Let's get into some of the policy promises on the domestic front that we've heard from this administration and the president around the word affordability, which our readers know was our term of the year in 2025, because everybody's searching for it in one way or the other. And let's talk about a couple of those things. Let's start with the capping of credit card interest rates at 10%. It's a pledge, a promise. Very hard to get that through with the American Banking Association and the finance company lobbies contributing a lot of money into this campaign and to others. How practical is that, and how possible might that actually be?
Well, I'll tell you, it's let me start with the possible first, because I think investors have not internalized yet that there's very likely to be another reconciliation bill, a big beautiful bill 2.0. That is something I think is much better understood in Washington than it is in markets. And the chair of the Senate Budget Committee, Lindsey Graham of South Carolina, has talked an awful lot about this, and has talked about it in two ways. One is just to say, look, we're going to do a little bit more of everything we did in 1.0, so fill all that in. But secondly, that creates a Republican-only forum to actually get a variety of other things done. So it is more possible today than I think most people believe, that you might get some of these populist policies like credit cards becoming law. That said, and last year at this time, you'll recall, people derided Trump for saying, "Oh, he wanted taxes on tips and a bunch of other no tax on tips and a bunch of other things," and he'd never get those, and lo and behold, he got them. So I think it's too early to dismiss that.
Also, we have promises about not letting institutional investors read private equity firms or Wall
Mhm.
Street buy single-family homes in all-cash deals to probably help bring housing prices down. Practical, is that even possible? And would that actually work if that was to be turned into law?
I think it. I think what you've got is you've got two things, and this is from the executive order. One is you've got a direction to departments and agencies that are under the president's control, exercise the president's power to do what they can in regulation. Secondly, there will be a legislative ask made, and either of those, I think, are kind of too little too late on the housing front. It will take them, realistically, the agencies, at least 6 months, maybe more, to finalize regulations, and then they'll get challenged in court. And secondly, you've got a situation where the Congress has to take up the potential law, and I think is less likely that they do that than more likely. So I think most of this has rhetorical benefit, but there may be some things on the margins that are helpful.
What's the most important piece of policy this administration could enact, or that might get struck down against them, maybe beyond tariffs, that you think will have the most significant impact towards the economy and towards investors in the next year to 2 years?
Well, one is since you mentioned tariffs, let me say that I think the anticipation about the tariffs decision is overblown. The reason why I say it is that the underlying international economic emergency is not even on the table at the Supreme Court. It's not something that the court is considering. It's not something the court would rule on. It will stay away from political branches and or political controversies and policy matters like that. That's the last thing the court's going to do. Secondly, I think the last thing the court's going to, I think it is more likely than less likely that the tariffs in the IEEPA law get struck down. But I have it as much more than a trailing risk that the court decides that those tariffs are within the president's powers under the law. Thirdly, regardless of what happens with the IEEPA law, president's got an awful lot of other tariff powers, and he will exercise those. So net, I think there's not going to be any disturbance. And finally, the last thing the court is going to do is immediately order disbursement of billions or even trillions of dollars to United States allies and competitors and opponents. I don't think that's going to happen at all. So, I think the tariff decision you really need to just kind of put to the side and not get too excited about. Beyond that, I think the biggest thing that's happening is frankly the desire to push policy towards defense and defense industrial base, and part of that is the onshoring of industry. So, the reinvigorating the industrial base is an immediate concern. It's a longer term concern, but it's something that is filtering all the way through markets and makes, I think, a huge difference in what an investment portfolio looks like.
Yeah, and that means defense stocks, obviously, and that means industrial stocks. That means a lot of those sectors that really haven't done that well over the past few years may have the wind at their backs.
Even down to autos,
Yep.
because anything that's that sounds strange, but anything that's conventional factory is prized.
Yeah, and it could all be deemed part of national security when you put national security and economic security together, which you do so well. Such great research coming from you at Pangaea Policy. Terry Haines, the founder of Pangaea Policy, thanks so much for joining the Express. Really good to have you.
Appreciate it, Cable. Thank you very much again for having me.
Terry Haines, Pangaea Policy. You got to follow his notes on LinkedIn. He does a great job. Also, very frequent guest on Bloomberg Surveillance. I always learn when I listen to Terry, and another great example there. Thanks so much. And we'll put his link in the show notes for you. All right, let's get to some money in motion, because despite the flight to safety, we've seen that it's been expressed through record high gold and silver prices. Global portfolio managers are as bullish on U.S. stocks as they've been maybe ever. Let's hit some money in motion. Looking at a recent note from B of A's Global Fund Manager Survey, cash levels, my friends, as a percent of assets under management are at their lowest levels since the bank started tracking this metric, sitting at just 3.2%. For context, those levels hit 6.5% in October of 2022 when the bear market of that year finally bottomed out. That's some serious optimism, especially given all the uncertainty out there. We were talking about it with Terry. We've been talking about it on this show for weeks. Tons of uncertainty, but stocks continue to sort of march up and to the right. Not only are fund managers' cash levels low, they are swimming naked, as Buffett likes to say. Net protection against a big stock market swoon is at its lowest levels since 2018. They are not hedging as much through options or treasuries or by shorting stocks or sectors. They are all in, and they don't want to get stampeded by a bull market in its fourth year. And it's not just fund managers, folks. It's us too. Individual investors, sentiment surveys, including ours, tell us we are bullish believers and we don't want to miss this rodeo. More bulls here than at a Garth Brooks concert. And according to JP Morgan Equity Research, retail buying, that's individual investors like us, is at its highest levels in 6 years. We went through a period where we were buying the dips last year through all the turbulence, and then we stopped towards the end of the year, maybe saving a little bit of money for the holidays, maybe getting ready for tax season, maybe not so sure that our gains would keep on gaining, but we are back to buying, and that is a lot of optimism and a lot of bullish consensus. And as our pal Liz Thomas at SoFi reminded us a few weeks ago, consensus, when everyone believes the same thing, can be a pretty dangerous force in the markets. It could be a good time to remember the watchwords of the GOAT, Warren Buffett himself, when he says, be fearful when others are greedy and be greedy when they are fearful. All right, massive week coming our way this week with a big Fed decision on the way. Probably no decision, but it's going to be a really important meeting and a lot of earnings. Let's look down the tracks at what is coming our way. All right, kicking things off here on a frigid Monday across the Northeast. Durable goods orders for the month of November. That's like 3 months old by now. And earnings coming in from Nucor, Ryanair will be reporting results as well as Brown and Brown, the big liquor distributor. On Tuesday, consumer confidence for the month of January is coming out. Consumer confidence has been ticking up a little bit in the past couple of readings, but it is still near multi-year lows. As I say, we feel terrible about the economy, despite what the headline numbers are telling us, which is that the economy is in decent shape. But real people don't live in headline numbers. We live in the real world, paycheck to paycheck. We'll get earnings from United Health, Boeing, Texas Instruments, UPS, and General Motors, among others. And that big interest rate meeting, the FOMC, begins on Tuesday. Wednesday, drum roll please, the interest rate decision from the Federal Reserve. And there's a really strong likelihood the Fed does nothing at this meeting. If you look at the CME Fed Funds Tracker, the Fed Watch tool that I'm pretty obsessed with, probably about a 98% chance the Fed just holds pat at this meeting, but it's going to be watching data coming over the next few weeks. There it is right there, the CME Fed Watch tool. Bookmark that on your laptops there so you can follow along as well. You see a very teeny chance of an interest rate cut. We'll probably get one if we get one in a couple of months. We're going to watch the labor market, but we also are probably going to hear about President Trump's new nominee for the Fed chair to replace Powell when his term ends in May. We have Powell's press conference on Wednesday as well, and then what a boatload of earnings on Wednesday. Microsoft, Meta, Tesla, IBM, GE Verona, AT&T, Starbucks. Are you not entertained? A huge week for corporate earnings, and Wednesday is a huge day for it as well. Thursday, we'll get the U.S. trade deficit numbers for November. We know that was improving in the United States' favor due to all those tariffs and threats of tariff, but 10 more earnings, and they're coming fast and furious. Apple, Verizon, MasterCard, Caterpillar, SAP, Lockheed Martin. I definitely want to hear what the defense makers are going to be talking about as we go into this reporting season, especially with all that government spending on defense coming our way. And then Friday, sound the alarm, another government shutdown alert. If the Senate doesn't vote to kick that spending bill down the road a couple more months, we could have another government shutdown at our doorstep right at a time where there's a lot of uncertainty about what's happening in the United States in terms of the economy. But another government shutdown, that would not be a good recipe for getting this economy on track right now. So we'll keep a close eye on that. We'll get the producer price index for December, a couple of weeks delayed there, and then earnings from ExxonMobil, Chevron, American Express, Verizon, Clorox, among others. What a massive week of earnings reports, FOMC decision, government policy out there, the Sell America trade still in the wind, and higher highs for precious metals. We're going to keep an eye on all of that, and let's get to our indicator of the week. And are the rich starting to feel the fade a little bit? I have been keeping a very close eye on premium brand resale values for things like Rolexes, Hermes bags, Birkin bags, etc. Wall Street Journal has a smart piece this morning about the fade in some of these prices on the resale market. And boy, oh boy, resale market for Rolexes and Patek Philippe and all the luxury watches and brands, that was really hot over the past couple of years. There was a lot of trying to keep up with the Joneses, so to speak, the wealthy Joneses, so to speak, but that has been starting to fade. And for some reason, Instagram really wants me to buy a good watch, and maybe they can hear me looking at these prices, but I'm just watching them because I'm curious. Check this out. Value retention is weakening, even for the very scarce luxury brands. This from the Wall Street Journal. Watch resale premiums have fallen really sharply. Rolex's average premium has dropped from 7% to 7% from 14%, and Patek Philippe has slid from 38% to 11% just over the past few years. And really over the past couple of months, we've seen a noted decline. Rising secondhand supply, that's as owners liquidate high-value watches, has added downward pressure on resale values. I'm also getting these videos of these folks walking into jewelry stores to try to sell their valuable watches, and I'm looking at that very closely because those values are continue to decline. Unless it's premium, you have the card, you have the documentation, that's what's happening. Primary market price hikes are eroding premiums too. Don't forget that a lot of these brands have been raising their prices. Patek Philippe raised U.S. prices 22% last year, outpacing resale market gains. And Hermes shows the same pattern with those Birkin bags. Resale premiums are at their lowest level since 2017. Shorter wait lists and supply is now closer to demand. Are we getting back into normalcy here, or are we seeing a real fall off in that secondhand market, which is a sign that the wealthy, not the top 1%, but I'm talking the top 5, 10, maybe 15%, they're starting to think a lot more carefully about how they spend their money. And we know that spending, consumer spending, especially by the wealthy, that drives a lot of gross domestic product, which, as I said, those headline numbers are really strong. But if the wealthy stop spending, things could spin out very quickly. So we're going to keep a close eye on resale values of a lot of those premium brands, as well as all the market moving news and indicators and trends coming our way this week and always on the Investopedia Express. Big thanks to Terry Haines of Pangaea Policy for dropping in with us with all that knowledge this week. Thanks to all of you for tuning in all over the world. We love the Investopedia Live audience. Thanks for joining the Express. We are on demand on all podcast platforms. So if you didn't watch us live, tune in on your favorite podcast platform, and we'll talk again a little further on down the line.